In this lesson, I'm going to show you and explain what hedging is. So, hedging is a strategy to reduce your risk, and it is used if you don't use your stop loss. Because, let's recap very fast what a stop loss is. A stop loss is a strategy that limits your risk. So, for example, what we are looking at here is the GBP USD chart weekly, and these bars are the Heikin bars. These are the bars we are going to trade. So let's say, for example, as we see here, price is going down, so we want to sell. And let's say, for example, that this red line is the entry order of a sell trade, okay? And this yellow line is the take profit. Of course, if you use the stop loss, the general rules about stop loss is that you put your take profit with a distance which is higher than the stop loss, and you set your stop loss over support, the previous support or resistance, like here, okay? So you should have a take profit which is higher than the stop loss, like in this scenario, okay? Now, you hedge if the price goes in the other direction. So if the price here goes up, of course, it is going against your trade, and you want, like, let's say, to lose only $100. So let's say you set your stop loss and you calibrate your size, your micro loss, in order to lose $100. Okay, so this is a strategy that reduces your risk of losing all your account money. Now, due to the fact that nobody knows where the market is going, I have the belief that stop loss is not the right strategy to use in order to reduce your risk, because you're basically trading on nothing than an approximation of something which has been studied in the past, but there's nothing to do with the future. It has nothing to do with the future. So let's say that this is our take profit, okay? Now we see that if price goes in the direction of the market, which is now on the downside, of course we're going to close this trade and we're going to make a profit. Now, if we close this trade, of course we want to enter back on the sell side, and so we will continue setting pending orders after pending orders after pending orders. Okay, so this is the other pending orders. This is our take profit, and so on and so on and so on. Now, we have to deal with stop loss if we set them and we just want to reduce what we think we are risking based on our technical strategy. If we hedge, for example, we are going to say like this: we don't set stop losses on our trades because we don't know if the price will respect technical analysis. Okay, so we say, for example, we see that the market is going down and we enter on the downside. We are willing to take like few pips of profits, like 20 pips, like here. Okay, so not a big price movement, and that's it. I mean, when the trade is closed, we are going to make money. But if the price goes against us, how can we handle this losing trade that could potentially become a big loss? Well, the strategy we use in order to lose the risk of losing everything is to enter with another trade. It will be a buy trade in the new price direction, in the new price market direction. So this is a buy trade, an entry level, as this is the sell level of our short trade entry point. So here we say we enter on a buy side with a long trade, and we set our take profit of our trade. Now, of course, what I'm creating here is like a trap, because let's say, for example, you were losing like $100 after the time the price goes from this trade up to here. Then you enter in the market with a new trade. Okay, so you have a buy trade. Now, if the price goes up, of course, you're going to make a profit from this trade here, and you're going to have the same loss from this trade here. Okay, it will be it will be higher than $100. If the price comes back and it goes south, of course, you will have less and less debt from this trade. You will be in profit here, but you will be in debt from this trade here. Okay, so basically you are locking $100 of debt here in this region of price. Because if the price is here, for example, you are making little profit from this long trade, huge debt from this short trade, and the difference between the two of them, the sum of the two of them, of course, is minus $100. Okay, so you're losing anyway $100. Well, there's a variety of ways to deal with hedging and to deal with losing trades that I teach, and that are taught in other modules. And let's recap very fast. This is based on the assumption, the hedging is based on the assumption that nobody knows where the market is going, which is a fact, so you can't hedge because hedging is a fact. Technical analysis is only an opinion. And you know that based on the market cyclic stagionality, market is cyclical, seasonality. So you know that market has always ranged, for example, in this region of prices, okay? So it will be very probable that the market will retrace back and your trades will be closed. Now, if you, for example, don't believe it, because there's no certainty of that anyway, even if there are political and fundamental economical information that can advise you that it is more important for nations and countries to maintain a currencies pairs stable as possible for rich countries. Anyway, you never know. So your strategy will be that up to the time the market is going to one direction, you will trade it and make profit, closing your trades. And you will never close the losing trade. You just only hedge all these trades, okay? When the price will come back, you will start trading in the previous market direction, and only one buy trade will be left, okay? Now, of course, during the process of trading with your account, of course, your capital will be growing, and up to the time it will be grown, of course, your new trades will be higher than the last trades. So, for example, and I'll show you in this example here. Now, let's say that, for example, you started trading with 1 microlot, okay? So, this sell trade was 1 microlot. It is red because it's a short trade. So, this is 1 microlot on the short side, okay? You basically, continue trading, market change direction, goes up, and you open a buy trade which is in size 1 microlot. So, for every price movement, of course, you are losing the same amount of money and making the same amount of money, because with these two trades, the bull one and the short one, the bear one, every pips has the same value of 1 microlot. Now let's say, for example, that you just made some money because market went to a direction, you closed your winning trades and you are lasting one losing trades, and your new capital now is higher. So what you do, of course, the new trades you're going to set are higher than 1 microlot and are like 2 microlots, okay? So basically, for example, in this situation, let me zoom in. Of course, even if, let's assume that our take profit are set on the same size, okay? Like around in this way here. Of course, the potential loss of your trade, of the sell trade if the market goes up, is this number of pips multiplied per 1 microlot, okay? but the trade you are winning is 2 microlots, which is like this distance multiplied by 2 microlots. So it is like two times this price range. And if you add these 2 microlots, of course, the number of pips per times the numbers of microlots, of course, you see that you'll make more money and you will close. Anyway, you're losing trade with the profit of your new trades, okay? That you will close winning, and you will still be in profit of this short number of pips here, but you will be in profit. Of course, you can tell me, why don't I do it for every trade I take without, rebalancing my microlots, the size of my trades, only if I have a bigger account. So why, I repeat, why don't I hedge every trade I have with the double, or if not the double, but more microlots than my previous one trade? Well, and that's very simple. You can't do it forever. Why? Because for every trade you are taking, just remember that your broker is taking out margin. And margin is like the insurance that your broker is asking you to give him in order to let you trade. It's like that he is taking out a little bit of your money from your account to cover your trade, okay? And of course, the beautiful part of hedging is that when you hedge a losing trade, for example, with 1 microlot, of course, your broker thinks like this. You have one trade which is going south 1 microlot, plus one trading which is going up 1 microlot, and the sum is 0, because these 2 trades are not doubling the risk, but are reducing the risk, because you have one side on the upside and one side on the low side. So they are eliminating each other. So basically, if you don't use stop loss and you hedge, you're reducing your risk, because your broker will take you out less margin. You will have more free margin to trade. But what happens if you continue doing it so and so and so? What happens is that, for example, you have 1 microlot. Market goes up. So let me clarify this to you. For example, let's say that market goes up. Oh, holy crap. Market goes up, and then it goes down, and then it goes down, and then it goes up again, and then it goes up again, and both of the time, every time, you have your trades, buy and sell trades, and you continue entering back. So you start here, market goes up, you enter one buy trade. Then price goes down, you enter another sell trade. Then it goes up, you enter another buy trade, okay? If the price is ranging in a consolidation, what do happen? Well, for every time that you are hedging the previous trade, you are going, of course, to enhance the risk, because you are going, of course, to have higher number of microlots traded. For example, you start here 1 microlots, price goes up, so now you trade with 2 microlots because you want the price to goes up, and when you close this trade, of course, you will be making money. Then the price goes down, and you say like, you know what? I trade 3 microlots, so I set a trade of 2 microlots, and it is like 2 plus 1, 3 microlots on the downside and 2 microlots on the upside. So the longest as the market goes down, I will be making profit. Okay, even if I have a losing trade, I will close this trade and I will make more profit. But if the price goes up again, you gotta enter back with other 2 microlots. Okay, so you have 4 microlots, and every time you are enhancing the number of microlots you are trading. Okay, and if you just take out the bull microlots from the sell microlots, let's say, for example, around here, you have 3 sell microlots and 2 buy microlots, The broker think that you are trading one market lots, okay? But if you continue doing so, you're trading every time more market lots. So anyway, you are enhancing your margin and you are reducing your free margin. So it is not something that you can do forever. It is risky to hedge in this way. And you can, even if you know you will never lose, if you have like a huge account and you start small, there is a high risk of losing everything if this game goes again and again and again forever. So, and you don't know, but you don't want to know it. So what do? You only, follow the market direction and set trades after trades after trades, and you only trade more market lots only if your capital is higher. Only if your account grows, you are going to trade on the market direction with more market lots, okay? Now, this is what hedging is. There are a lot of varieties of hedging techniques, and this lesson was about explaining you what the true intrinsic power of hedging is. You have to master it, of course, because if you trade without mastering it, it can be very dangerous. But if it is done correctly, it is impossible to lose money on it.